Hello everyone. These days I have been seeing lot of reels which are talking about best tax saving option in mutual funds using tax harvesting. So I decided to check, is this for real or is it just mathematical? So I chose a fund, Canara Large Cap Regular Growth, for a period Jan 2020 to April 2025 and checked how this tax harvesting worked if someone withdrew 1.25 lakhs every year, claimed zero long-term capital gains tax on it and reinvested on the same day. How did it help them? Something really interesting I found while doing this exercise, and I'm going to share that with you in detail, also explaining what this tax harvesting is all about. So stay tuned and watch this complete video. So now let me begin explaining how this tax harvesting actually works. Before we go ahead with example of tax harvesting, let's understand how how will this investment work if we don't exercise anything. Like let allow the investment to grow and withdraw it after 5 or 6 years and then pay capital gains. How does that look? Once we understand that, we'll move to tax harvesting. So assume a person invested money 5 lakh rupees in Canara Large Cap Regular Growth Fund on Jan 1st, 2019, when the NAV was 23.88. Now, which means that the person has got allotted 20,938 units in that particular year. Now it had grown over period of time. Say in April 2025, the NAV was 58.08. So the value became 12,16,080 rupees. What it means is that 5 lakhs has grown to 12,16,000. Now on this particular money, if somebody had sold on April 1st, 2025, they will have to pay capital gains. Capital gains is 12,16,000 minus 5 lakhs and an additional 1,25,000, which is tax exemption limit for every year. So LTCG exemption limit. Once that is done, on 7,16,000, 12.5% is the tax. So in effective, the person after paying taxes made 11,52,000 by investing 5 lakhs. Okay, this is basic normal investing into a particular mutual fund. Now we'll talk about what is this tax harvesting and how does it work and how it worked for this particular example. Now, tax harvesting basically means that a person invests a particular money in a mutual fund. Every year after it turns to long-term capital gains, which is after it crosses 1 year, 1,25,000 rupees is withdrawn in order to claim that exemption. You don't need to pay any tax on it. And then reinvest on the same day so that you are actually not hampering your investment and its growth because you're buying at the same units, same NAV, which is helping you save tax. Tax harvesting is basically a principle where by booking profits and reinvesting, you are actually saving tax and you are maximizing the benefits of tax savings that are available to us. This is a conceptual idea about tax harvesting. Now let's understand how does it work mathematically. Okay. Now same example, 5 lakh rupees invested on 1st Jan 2019, 20,938 units were allotted, and on 1st Jan 2020, this person withdraws 1,25,000 to claim that benefit, which means 4,516 units are redeemed. Now the same amount is already vapas they have invested. So what has happened here? Old units became 16,422, new units got added 4,516. Right? You're getting me till now, right? Units remain same at the end, but just that 1,25,000 withdrawn and reinvested. Now the same thing they have done again in 2021. Same thing got done in 22, 23 and 24. Now we'll come to 2025 and see how it actually reflects. In 2025, the NAV was 60.64, which means 1,25,000 rupees worth units are 2,061. Now what has happened is out of that original lot of 20,938 units, right now, after exercising in 2025, only 2,280 units are remaining. Rest all units are new ones because of this reinvesting. What it technically means is that the cost value has changed. How? In the first year, 1,25,000 reinvested. Second year, 1,25,000 reinvested, so on and so forth. So at the end of this fifth or sixth year, the cost value has grown from 5 lakhs to 8,04,000. In technical terms, your investment value has not changed. You have not put any new money. It's just that you have booked profit and reinvested. So your cost value has increased from 5 lakhs to 8 lakhs. Now let us see if somebody on April, the same person on April 1st, if they chose to redeem all the units. Now what would have happened? So again, units are same, 20,938, and on 1st of April, the NAV was 58.08. So the value was 12,16,000, right? Out of which now what is the LTCG amount? This 12,16,000 minus 8,04,000 minus another 1,25,000, because this financial year after April, it's a new financial year. So you will get another 1,25,000 benefit. So the LTCG amount, long-term capital gains value, is 6,79,000. Minus 1,25,000, it becomes 4 lakhs odd. Now on this 4 lakhs, 12.5% tax, which is 51,453 rupees. Now there is 1,25,000 which is purchased on Jan 1st, 2025. This is still short term because it has not completed 1 year. On that, there will be a short term capital gains tax. So 1,25,000 is taxed at 20% because short term capital gains is taxed at 20%. So in effective, the total tax on this particular transaction is 76,453. What it means is net after taxation, 5 lakhs has grown to 11.39 lakhs. Whereas in the without doing all this exercise, it was 11.52 lakhs. So in all technical terms, by not doing anything, this person has gained more than by doing this exercise of tax harvesting. This is actual real data of this particular fund. So now I have not even considered in this the practical challenges of doing this, exercising this tax harvesting. Number one is it's practically impossible for someone to sell and buy 1,25,000 worth of units on the same day with same NAV in any mutual fund. First, you place the sell order. You will get the proceeds after T+2 days, 2 working days. Then you invest. The money gets allotted after clearance of these funds. So technically 3rd or 4th day probably. So in all real sense, investing, selling and buying is not going to happen on the same day. That's point number one. Point number two is you have to keep track of this every year and keep churning, keep investing. This is practically not doable exercise. Now, in order to save few thousands, in this particular example, it's not even tax saving. There is no possible profit in this particular example. So why would somebody, churn the portfolio for saving probably few thousands of taxes? It's not even few thousand here, right? Instead, it's always better to stay invested and allow the power of compounding to work on its own. The more time that you stay invested, the more amount of money that you're going to make. That's the magic of power of compounding. And this is my take on tax harvesting. Let me know, what do you think about tax harvesting? Do you think it will benefit you? Let me know in comment section, and I'm here to understand from you what is better.